Welcome. This is an intermediate level presentation on 1031 tax-deferred exchange issues. My name is Scott Saunders, and I'm a Senior Vice President for Asset Preservation, Inc. Asset Preservation is a leading national qualified intermediary. And in this presentation, we're going to cover some intermediate level concepts. It's important in any 1031 exchange transaction that you as a taxpayer consult with your own tax and legal advisors regarding the specifics of your situation. So with that, we're going to get into today's presentation, and you'll see on the outline there, I'm not going to go through each bullet point, that we're going to cover quite a bit of information in a fairly short period of time. We're going to flush out in a little bit more detail some alternatives with like-kind property, specifically looking at things like vacation home exchanges and Delaware statutory trust, what we call fractional ownership. I'm also going to spend some time talking about 1031 and what's known as Code Section 121. So that's the primary residence tax rules and some different scenarios. So let's jump into a 1031 exchange. A 1031 exchange is a very powerful tax strategy that allows anybody, so an investor or a business owner, holding a property for investment purposes or for use in a trade or business, to potentially defer all capital gain taxes that would otherwise be incurred if the property was sold for cash. 1031 exchanges have been a part of the tax code since 1921. And by the way, you'll notice that they're referred to as a 1031 exchange because it's really Section 1031 of the Internal Revenue Code that provides the guidance for these. So this is a powerful investment strategy, and really the concept behind it is what's known as continuity of investment liquidity, that the taxes are not paid until the investor really sells the property for cash and receives cash. They're merely reinvesting from one property held for investment or used in a business for another replacement property used the same way. So that's what an exchange is about. We're going to go into quite a bit of information in this presentation. When we look at one of the reasons driving 1031 exchange activity is an increase in the capital gain taxes. And so back in 2013, we had capital gain taxes increased from 15% for the high earners up to 20%. And we also got the addition of the net investment income tax. So this is an additional 3.8% surtax on higher earners. So it's what's called on net investment income. And that affects capital gains is considered net investment income. So that's one area that's really fueling the increase in 1031 exchange activities. The other aspect is we've had a very strong real estate market, and really we've had both the commercial market very, very strong, and that's been that way for quite a while. So we've had commercial prices going up. Also on the residential side, we've seen a really strong increase in residential home prices. In fact, just recently, National Association of Realtors came out and said nationally, residential prices from the downturn, from the very bottom of the downturn, are up about 40%. So you've got investors that own single-family homes having not only appreciation, but they've got rising rents. Commercial property owners are having the same dynamic. And so the bottom line is taxpayers that are out there are looking for a way to maybe defer paying their capital gain tax liability, and they're exploring 1031 exchange treatment for that. When we look at the taxes that someone would pay if they don't do an exchange, so in a taxable sale, there really are four different components that you need to look at. First off, taxes are paid on the depreciation recapture at a rate of 25%. So if you've owned a property for, let's say, 18 years, all of that depreciation that you've taken on each of those 18 years, that will have to be recaptured at a rate now on a tax rate of 25%. The remaining economic gain is taxed at either 15 or 20%, depending upon the taxpayer's taxable income. And then the third component would be this net investment income tax. So it's an additional 3.8% tax that applies to what's called net investment income, and that includes capital gain. Now the thresholds for that are $200,000 for single filers and $250,000 for married couples filing jointly. So any income over those threshold amounts face that additional 3.8% tax. And the final component is the state tax. So some states have no tax. A handful of states have that. Some have lower taxes. Some states have significant taxes. California, as you'll see on the screen, the maximum tax rate in California is 13.3%. So if somebody's going to go ahead and sell a property and pay the taxes, you have to look at all four levels of taxation potentially and finding out what the total tax liability will be. As an investment property owner, you really have just three different options available to you when you hold property. One is what's called a buy and hold strategy, and many investors take advantage of that. They buy a property and intend to hold it for a long-term investment. The only thing you might want to consider there is that if you're in a part of the marketplace where there's not a lot of job growth, there's not a lot of economic activity, you might be missing out on significant upside potential on appreciation and rents. And maybe it makes sense to consider exchanging out of an area where it's a soft economy, not a lot's growing, not a lot of job creation, and exchange into a part of the country that has robust job growth and has a lot better long-term appreciation potential, long-term potential for increasing rents. So that's why some people look at doing exchanges. Second option is to sell a property and pay all four levels of taxes. So what I just covered, pay the depreciation recapture at 25%, the remaining gain at either 15 or 20%, depending upon your taxable income, the 3.8% net investment income tax, if it's applicable, and state-level taxes. Here's the challenge with that scenario. The challenge is after you pay all those taxes, you're left with after-tax equity to reinvest into something that's outside of real estate. And it's very challenging to get the same rate of return on your net equity invested outside of real estate versus having all of the gross equity in a 1031 exchange redeployed into another replacement property. So this might be a viable option for somebody that wants to get out of real estate, but from a return on investment standpoint, it can be challenging. So that's something, again, you want to crunch the numbers with your tax advisor, your legal advisor before selling to really look at what the tax liability would be on the property that you're contemplating selling before you close. Third option is to do a 1031 exchange, and you can defer potentially all the taxes in an exchange, and we'll look at how to do that a little bit later on, or you can receive some of what we call boot. Boot is simply defined as non-like-kind property. So you can receive some cash out of the transaction. That's called cash boot. You could have a reduction in your mortgage liabilities. That's called mortgage boot or debt relief. And so you can certainly do it either way. Many investors choose to obtain partial deferral. They pay some taxes today by receiving some boot, and they do a 1031 exchange and maybe pick up one replacement property. So just keep in mind that a 1031 exchange is really not an all or nothing proposition. You can obtain full tax deferral if you elect to, but many investors opt for partial tax deferral. So that really depends upon your individual goals and your financial circumstances. Now the code on the next screen that came about back in 1921, I just want to review that briefly. It simply states, no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. So some key takeaways when you look at this. First off, this is what is called non-recognition treatment. Sometimes you'll hear this mistakenly referred to as a tax-free exchange, and that's not accurate. It's really a tax-deferred exchange. The basis of the relinquished property gets rolled over into the basis of the replacement property. So the gain doesn't go away, and later on when the taxpayer sells for cash, they'll owe the capital gain taxes based upon the gain. So it's non-recognition treatment. When we look at the types of property, and we'll look at this in a little more detail shortly, it's very, very broad with real property. You can exchange a business property for a business property, an investment for any other property held for investment, a business property for a property held for investment, or maybe an investment property exchanged for a property that's going to be held for business purposes. So very broad And again, we'll look at this whole concept of like kind a little bit later in the presentation. And what I want to do is share with you some different things that maybe you've heard about, and I want to provide some clarity on things like vacation home exchanges and fractional ownership and give you some insights there of things to look for. Now, there are some things that don't qualify, some exceptions to Section 1031. Stock and trade or other property held primarily for sale is excluded. So stock and trade is inventory held in the ordinary course of business for sale to customers. That's excluded. The other part of this bullet point, or other property held primarily for sale, is fairly broad. If the intent is to hold for sale purposes, not to hold for long-term investment, so with an income property for rental income, then that's excluded. So on the next slide, we're going to look at what are some of the factors that the IRS looks at to determine whether the taxpayer intends to hold the property for long-term investment or the intent is for sale purposes. Then I want to draw your attention to the fourth exception. An interest in a partnership is excluded from 1031 exchange tax deferral. So a partnership interest, so an interest in the partnership, is a personal property interest. It's not an interest in the capital asset itself. So any entity can do an exchange up at the entity level. So a partnership that holds investment real estate can do an exchange if the whole partnership relinquishes and buys a replacement property. An S Corp can do an exchange, a C Corp, a trust, an individual. But an interest in a partnership interest is a personal property interest, not an interest in real property, even though the partnership or LLC owns real property. So we'll look at some planning opportunities shortly in that regard, but I just wanted to mention that one. Let's go into a little more detail of some of the factors that the IRS might look at to determine whether property is being held for sale or long-term investment. They can certainly look at the purpose for which the property was initially acquired, how it was subsequently held, and certainly how was it held at the time of sale. The extent to which improvements were made to the property. So if somebody buys a large parcel of land and subdivides it and they put in roads and they go ahead and install utilities for sewer and gas and electric and water, they look a lot more like a dealer or developer holding for sale purposes rather than long-term investment. The frequency, number, and continuity of sales, the extent and nature of the transaction, the ordinary course of business of the taxpayer. So it's a very different fact pattern if you maybe have somebody that receives most of their income from another profession, and in 1 year they happen to turn over a couple of properties. A very different fact pattern than somebody maybe who is a dealer or developer who gets the majority of their income turning over real estate. The extent of advertising, any active efforts to obtain a buyer to purchase the property, and the listing of property with a real estate agent or a real estate broker. These two certainly tend to indicate that the property is being held more for sale. So in real estate, we have the term that many of us are familiar with of people that do what are called fix and flips. They get an asset at a favorable price, they fix it up, and shortly after they acquire it, they put it back on the market for the short-term profit. That is a property that is being held generally for sale purposes. Even though there's a profit made on it, the intent of the taxpayer with a fix and flip is to sell it as fast as possible, and then generally they go back and they'll buy another property and do the same thing. So you can't do an exchange on most fix and flip properties if the intent is to hold for sale, not to have it rented out and to hold for long-term investment. So keep that in mind. On the next slide, you'll see a little bit more information on the partnership issues. And so this basically says what I had stated just a few moments ago, that a partnership interest is excluded from Section 1031 exchange treatment. So if a partner, and when I say a partner, that can be a partner in a partnership, it can be a member in a limited liability company, generally referred to as an LLC. If you want to do that, let's just say you have 3 partners, they each own a third interest. 2 would like to do an exchange, 1 just wants to sell and pay the taxes. Well, you can't do an exchange on a partnership interest. So you've got to convert the partnership interest into an interest in the capital asset, where each one of those 3 owners actually owns an interest in real property, not a partnership or a personal property interest. The way that this is typically handled in exchange, and there are two different approaches. These are some kind of 1031 vernacular. You'll hear this referred to as a drop and swap approach or a swap and drop. So the drop means distributing an interest in the property that was owned by the partnership now down to, let's say in my example, 3 tenant common owners that each own a 1/3 interest. So the drop is that. The swap just means 1031 exchange. So one approach is to go ahead, drop it out to the 3 former partners. They each own a 1/3 interest. 2 at the time of closing. It work with separate qualified intermediaries, and they do a 1031 exchange into other properties, not together. And the 3rd former partner receives the cash and pays all the taxes owed. Now, another alternative then is what's called the swap and drop. And this one here involves basically the same approach, but it's flipping the order around. The partnership stays intact and purchases a new property. And then after the exchange is over, they might distribute an interest in that replacement property to the partner that wants to depart and leave the partnership. This happens much more rarely. It happens sometimes in closely held partnerships, maybe 2 or 3 family members, something like that. Far and away, the more common approach is the drop and swap. Now, the issues to consider, and you'll see this coming up on the next slide here, is really looking at the period of time that's involved. So ideally, you'd like to have a period of time where you season the holding with the former partners, and they hold it for a period of time. And the longer, the better. So you'll see the 3rd bullet point there. It says the more time between the drop out of the partnership and LLC and the swap, the 1031 exchange, the better. So that would be the ideal way to do it. In the real world, sometimes people don't always do things from an ideal perspective. So when we look at issues, you'll see on the next slide here, we've got a number of federal cases that provide some good authority where taxpayers prevailed. So you'll see the decisions Boker, Mason, and Maloney. These are ones where the taxpayers prevailed by having a situation where there wasn't a really long holding period before interests were converted. However, you'll note on the 2nd bullet point that in the state of California, this is a challenge because the Franchise Tax Board has taken the position that they're not bound by the federal tax court decision. So the state of California is aggressively pursuing investors that may opt to do this for the state level taxes that are owed. So keep that in mind. At this point in time, if you're in California or selling property in California, you really want to talk with your tax and legal advisors if you're looking at doing a drop and swap or swap and drop. Keep in mind also that when you do these different formats, the federal partnership return was modified back in 2008, and you have to disclose when you file the partnership return, did you do a drop out of a partnership or LLC right before a 1031 exchange, or did you do it afterwards? So it makes it a little riskier, and certainly the IRS is getting that information where they can maybe come back later on and challenge it. On the next slide, you're going to see like-kind property. And these are all images of like-kind property. So like-kind property, when we deal with real estate, real property, is very, very broad. Any real property held for productive use in a trade or business or for investment can be exchanged for any other real property held for productive use in a trade or business or for investment. Very broad. You can exchange out of bare land into improved property. You can go into an office building, industrial, commercial, all sorts of things. But you'll see some images on this screen here of things that maybe you haven't thought of. Certain oil, gas, and mineral rights can qualify for an exchange. Water rights, if they're considered real property under state law, can potentially qualify. Transferable development rights, more commonly referred to as air rights, can qualify. So there just are so many options available. You'll see that the types of property that are excluded would be the taxpayer's principal residence, the house that they live in. That does not qualify for 1031 exchange, as well as property that's held for sale purposes or dealer property. So we already looked at that. So those are the types of real property that are excluded. Any other real property held for investment could be exchanged for any other type of real property held for investment purposes. With personal property, the rules are much more narrow and specific. you generally have to exchange for a property that's considered like class or falls within the same North American Standard Industrial Classification. So, for example, you can exchange a corporate aircraft for another corporate aircraft. You can exchange rental cars for other rental cars. There are a lot of different options there, but you've got to make sure that you're really going into a like class property. So there are exchanges of cars and collectibles that are held for investment. There are exchanges of art collections, exchanges of gold coins, and you might even have a property that's what we call a mixed-use property. Maybe there's a hotel that has some personal property and some real property. So you need to line up the real property component and then line up the personal property components. Let's look at a little more detail on some types of like-kind property where there are some neat planning opportunities for you as an investor. The first one is this whole concept of a vacation home. So when I say vacation home, we'll get into the details. This is not a second home that's just personal use. Back in 2008, the IRS came out with RevProc, or Revenue Procedure 2008-16. This created a safe harbor for vacation home exchanges. So as long as you follow these rules, the IRS will consider this vacation property or resort property held for investment. And those rules are fairly straightforward. I like to call it the rule of twos. First off, the properties must be owned by the taxpayer for a minimum of 2 years. This is called the qualifying use period. Within each of these 2 12-month periods, the taxpayer must rent the property at fair market rent for a minimum of 2 weeks. So 2 years of holding, at least 2 weeks of rental income. And note in this revenue procedure, you can rent to family members as long as it's rented at fair market rent. And then finally, the taxpayer's personal use of the property cannot exceed 2 weeks or 10% of the time it's rented. So in summary, a 2-year holding period, a minimum of 2 weeks of rental income at fair market rent, and the taxpayer cannot have more than 2 weeks of personal use of the property during this 2-year period. So a lot of parts of the country have vacation and resort and those types of properties, recreational properties. I think it's a tremendous planning opportunity. Another opportunity is this whole concept of fractional ownership. And that's kind of a general catch-all phrase. This is where the taxpayer exchanges into a slice of a much larger building, generally a large commercial building. So there are many co-owners in one larger commercial property. The big advantage of this type of ownership is the investor goes from actively managing to a relatively passive investment. I'll say the word relatively. You're still exchanging into real estate. So real estate can have tenants move out and tenant improvements. And, there are all sorts of variables with owning real estate as an investment or asset class to consider. But a big advantage is going to relatively passive ownership. Another one is you're going to generally have professional management. So these are put together by a sponsor, and they'll oversee all of the leases and the management responsibilities. Typically, you're going into a higher grade property, generally a grade A or grade B type property that's a large commercial property. So it gives you a chance as a small investor to get into a slice of a commercial property. The risks that are involved with fractional ownership, what I first mentioned, you're still at the end of the day exchanging into real estate. So you want to make sure that you like the asset class, that you like the sponsor, that they have a good track record of managing properties. You want to look at the leases. How large are there rent escalators in the leases? Who are the tenants? Et cetera, et cetera. So anything that you would evaluate in any real estate investment. Now, these were sold starting back in 2002, primarily what was known as tenant in common ownership, or referred to as TICs. And they became very popular from 2000 to probably 2008, very popular. Today, most of these are sold in a Delaware statutory trust, what's known as a DST. And you'll see Revenue Ruling 2004-86 provides the authority for that. These are a good alternative for people that want to go passive. It's also something where we see taxpayers looking at maybe using this as a second replacement property. Maybe they have some boot left over, some cash boot that would otherwise be taxable, and they'll exchange into a DST and get the tax deferral So that's something to keep in mind. The group that has a lot more information on this is called the Alternative and Direct Investment Securities Organization, and their website is adisa.org. Now keep in mind with these investments, these are only for people that are defined as an accredited investor. So these are really considered what's known as a Regulation D offering. You have to be an investor of a certain level of sophistication and financial capacity to even qualify for these. These are also sold by financial advisors. So the SEC considers these a security, even though they qualify for 1031 exchange tax deferral. So you don't purchase a DST through a real estate agent or broker. They're purchased through a registered financial representative that has the appropriate security licenses. One of the questions we get asked a lot at Asset Preservation is about the holding period. How long does a property need to be held before it's considered held for investment? And the answer to that question, even though it sounds like a simple question, is probably a little bit more nuanced. The key issue in any 1031 exchange is that the intent of the taxpayer is to hold the property for long-term investment. Now, the taxpayer's intent is very subjective. So what the IRS and the tax courts will look at are what sort of objective factors that they can discover that either tend to support the intent to hold for investment or tend to contradict that. So the IRS will look at the taxpayers, all of the facts and circumstances, and certainly the holding period is important, but keep in mind it's just one of a whole list of factors the IRS will look at. So in a perfect world, you as a taxpayer performing exchange would have multiple factors that help document, to help establish that your intent with the property was to hold for long-term investment. If the IRS discovers that there were a whole bunch of contrary facts, that could certainly be a big strike against you in an audit. So it's really important that your intent is to hold for investment. The IRS is going to look at all your facts and circumstances, and it's not on this slide, but I want to mention it, it's really important in our mind that you create a paper trail, create a documentation that helps show your investment intent. So correspondence with your tax and legal advisors to that extent, correspondence with your real estate agent or broker. Put those in place at the time you're doing the exchange. It puts you on a much solid ground, much better ground if you're ever audited down the road. Now you'll see there I've got a couple of tax court decisions. The first one there, Goolsby versus Commissioner, is a 2010 decision. This one, the taxpayer moved into a replacement property, acquired an exchange, a couple months after the exchange was over, and the IRS said they did not have the intent to hold for investment, so they didn't qualify. The other one's a little more interesting. In Reesink versus Commissioner in 2012, there's what we would consider a relatively short holding period of only 8 months. However, the taxpayer was able to substantiate that their intent really was to hold for long-term investment, and they were able to demonstrate to the IRS that they had a lot of facts and circumstances to support that. And in Reesink versus Commissioner, the taxpayer did get 1031 exchange tax deferral. So these are the things you want to review. Again, so important that you review your specific transaction, your unique facts and circumstances with your tax or legal advisors prior to closing, because you want to get their input and guidance on that, because they may know of factors and variables that maybe you hadn't considered. So critical to do that. Now, switching gears, let's look at the requirements for full tax deferral, and we call this the exchange equation. As a taxpayer, if you want to obtain full tax deferral, you really need to do two things. Number one, reinvest all of the net exchange proceeds. So all of the net equity after the closing costs should be reinvested in one or more like-kind properties. Number two, acquire property with the same or a greater amount of debt. So you look at the mortgage payoff on the property being sold. To have full tax deferral, you want to have at least that amount of mortgage on one or more replacement properties. So the net equity you can see on the settlement statement, that should be reinvested. To the extent you put money in your pocket, that's called cash boot. So that's the term that, and I mentioned that earlier on. So put proceeds, pull money out, and you can do that, but it's taxable to the extent that you have a capital gain tax consequence. The mortgage, if you go down in mortgage, that's called mortgage boot, sometimes referred to as debt relief, also taxable. The one caveat to the second requirement is you can offset a reduction in mortgage by adding new cash, outside cash. So you can go down a mortgage, but if you offset that by adding new cash, there is no mortgage boot. So let's walk through 3 different examples. First example, you sell a relinquished property that's worth $900,000. The debt is $300,000. Closing costs, that'd be the real estate commission, title company fees, $60,000, leaving net equity of $540,000. You purchase a replacement property for $1.2 million, so you go up in value. Now you have to look at the debt and the equity. So here, the debt goes from $300,000 to $660,000. There's no mortgage boot. The net equity is 100% of it's reinvested, so there's no cash boot. So this is an example of full tax deferral. Now let's look on the next screen. Taxpayer goes down in value. So the debt goes from $300,000 to $260,000. So there's $40,000 of mortgage boot. The taxpayer takes out $100,000 cash, $100,000 cash boot. The total boot, when you combine those two together, is $140,000 of boot. So you add those two together. And then the last example I want to show you here is a situation where somebody reinvests all of their net equity, but they go down in mortgage. So they go from $300,000 of debt and only have $260,000 of mortgage on the replacement property. This is an example where there's $40,000 of mortgage boot. So just keep that in mind. This is the one that sometimes can surprise taxpayers if they don't analyze both the debt and the net equity, because they think I've reinvested all my cash, but they forget that they need to have the same or a greater amount of debt. Now, when we look at exchanges, I'm going to walk through the most common variation, which is called the delayed exchange, and walk through kind of the steps involved. So up at the top is the taxpayer. That's the person that owns a property held for investment or a business property that they use. They list the property. The property gets under contract. So there's a buyer for it. They go ahead now and they've got a property under contract. At that point in time, that's when you'll contact the qualified intermediary. So it's very important. You need to contact the qualified intermediary prior to closing. You can't set up a 1031 exchange after you close. It has to be done prior to closing. Qualified intermediary is going to prepare a number of 1031 exchange documents. One of those is an assignment of the contract. So we, the intermediary, qualified intermediary, we, with an assignment of the contract, we step into the shoes as the seller of the relinquished property. So we sell the property to the buyer. So you see the money coming to the qualified intermediary. We sell it. We instruct the closing officer to directly deed the property over to the buyer. So that's the first part of an exchange. Then the taxpayer looks for a property they want to buy. They get that property under contract, contact the intermediary, and now we prepare some paperwork. We prepare an assignment of that purchase contract. So now we step into the shoes as the buyer of the replacement property. So we purchase it. So you see the money going from the qualified intermediary over to the seller. We buy it, and we instruct the closing officer to directly deed it. So as you see in the diagram, the qualified intermediary sells the relinquished property. The qualified intermediary buys the replacement property. The taxpayer is merely giving up a deed to the relinquished property and receiving a deed to the replacement property. Now you'll see the timelines, so we're going to talk about these. When the property closes, that starts what's known as the identification period and also the total exchange period. So from that closing date, the taxpayer has a maximum of 45 calendar days to identify property they want to buy. Now this ends at midnight of the 45th day. So some things to consider. First off, if the taxpayer buys a property within the 45 days, meaning they close on it, that is considered identified. The taxpayer can also substitute properties. So they could identify, for example, 3 properties, A, B, and C, on day 8. And on day 43, they unidentify A, B, and C, and they substitute with D, E, and F. So anywhere within that 45-day period, up until midnight of the 45th day, you can substitute properties. So you've got flexibility. Once you pass midnight of the 45th day, under the 1031 exchange rules, you need to buy property that was identified within that 45-day period of time. So the taxpayer has 45 days to identify, plus another 135 days. So a total of 180 days for what we call the exchange period. So the maximum time period is 180 calendar days, or the date the taxpayer must file its tax return for the year of the transfer of the relinquished property, whichever is earlier. Excuse me. So those of you that are closing around the middle of October, if you happen to file your taxes around the middle of April and you want the 180 days, what you need to do is file an extension, acquire your replacement property in 180 days, and then file your tax return. If you filed your tax return, you would be shortening your exchange period. So every taxpayer is eligible for the 180-day period. So keep in mind it's 45 days plus 135 days for a maximum of 180. So that 45 is inclusive within that time period. How do you identify? There are three different rules of identification. First rule is what's known as the three-property rule. Under this, taxpayer can identify three properties, so they're limited to three, but the fair market value is unlimited. So the number of properties limited to three, unlimited value. The 200% rule is kind of the reverse of that. This one says the taxpayer can identify an unlimited number of properties, but the total fair market value of all those properties can't exceed 200% of the value of the relinquished property. So if they sell for $1 million, taxpayer can identify an unlimited number, but the value of those properties cannot exceed $2 million. So if you look at the three-property rule, you're limited on the number of properties, unlimited value. 200% rule, unlimited number of properties, but the values, there's a restriction, no more than 200% of what you sell. And then finally, the last rule is what's called the 95% rule. Under this one, you really have an unlimited number of properties and unlimited value, but the caveat is the taxpayer must acquire 95% of the value of all properties identified. So the rule is called the 95% rule. So when we say acquire, that means close on 95%, at least 95% of them. So the rule says 95%. In real life examples, this generally means you got to close on everything, right? Everything has to be acquired. So these are the three rules. You just have to pick one of these three rules to identify property on. Now, a commonly asked question is, how do I identify property? The key thing is it has to be done in writing, and you have to unambiguously describe the property. And let me back up for a moment. These are the rules of identification. There's no requirement that you're under contract, that you have a signed purchase and sale agreement. You merely have to meet these rules for identifying. Practically speaking, asset preservation recommend that you're certainly negotiating with sellers, feeling like you can come to terms on a price that's acceptable to everybody, and you can acquire the property. So you don't need to be under contract. At the same time, you probably should be actively negotiating and having a pretty good idea that the properties you identify, you're likely to be able to go under contract on. You must unambiguously describe the property. So let me give you a couple of ways to look at that. It could be a street address or a legal description. So it could be an assessor's parcel number if it's land. It could be a specific property. Let's just say you're going to buy a two-bedroom, two-bath condo in Maui. It's not any two-bedroom, two-bath condo. You have to identify a specific unit. I'm going to buy unit 32 in this particular complex. So it has to be unambiguous. When you're looking at DST, acquiring a Delaware statutory trust, you also want to identify the fractional ownership that you're going to acquire. You could do that by percentage or by dollar amount, but you're not going to identify an $80 million building. You're going to identify your particular slice of that $80 million building. That's unambiguous. It has to be hand-delivered, mailed, telecopied, or otherwise sent by midnight of the 45th day. Generally, this goes to the qualified intermediary, or it can go to any other party related to the exchange who is not a disqualified person. Practically speaking, most people choose to identify with the qualified intermediary is the way that normally goes. Now let's look at a couple of other examples. This is a multiple property exchange. So this is when a taxpayer is going to sell three relinquished properties, consolidate that equity into one replacement property. So the properties are sold. The money comes from the three sales over the qualified intermediary. We then go ahead, step into the purchase contract, buy the replacement property to finish the exchange. The thing that I want to point out under this scenario is if you're going to have one exchange with 3 relinquished properties, whenever property 1 closes, it starts the 45 and 180-day time period for properties 2 and 3. So just keep that in mind where you're trying to consolidate and sell several properties as one exchange, that you want to maybe get that property under contract, that first one, but push back the closing date, and then be realistic on the sales price for properties 2 and 3 if you want them involved in one exchange. The next example is a multiple property exchange with 3 different replacement properties. So the taxpayer sells one property to the buyer, money comes to the qualified intermediary. We now then step into those purchase contracts through an assignment. We buy 3 replacement properties and have them deeded back to the taxpayer. This is the more common scenario. We see a lot of taxpayers sell one property, and they might buy either one larger property or exchange into multiple replacement properties. So that you've got the same timeline. This is just one exchange for multiple properties. There's another variation that's available to your clients, and these are what are known as parking arrangements. So when we say a parking arrangement, this is a situation where the intermediary or an entity owned by the intermediary is parked on title, meaning we actually are on title to the property. So there are a number of different ways of doing these. We had guidance back in 2000 with what's known as Revenue Procedure 2000-37. And under that revenue procedure, just like we had with vacation homes, they created a safe harbor for parking arrangement transactions. And there's more detail than I'll go into in an intermediate level presentation. We're going to have a specific webinar just on parking arrangements. But one of the key takeaways under the revenue procedure is there's a maximum 180-day time frame to accomplish this. So a reverse exchange is buying the replacement property first and then taking 180 days to sell the relinquished property. This can be a great alternative if there's an off-market deal where somebody needs to close right away on it. Maybe it's an opportunity where you've got a really good purchase opportunity, great property at a great price, but the seller says, I need to close right away. The first person that buys it from me is who I'm going to sell to. So in an area where there's a lot of limited inventory, reverse exchange could be a wonderful strategy. An improvement exchange is where the taxpayer is going to build a new property. It could be from the ground up, or refurbishments can be made to an existing property. Maybe improve a C-class apartment complex, multifamily, put in new bathrooms and kitchens, and bump it up with exchange money, exchange equity. So now it's a B-class building where the taxpayer can charge higher rents and get a better rate of return on their investment. So that's an improvement exchange. A reverse improvement exchange is combining those two strategies. Buy the land first, begin constructing the new property, and then have up to 180 days to sell the relinquished property. We see a lot of owner users that may take advantage of this strategy. They've got a business operating. They can't afford to shut it down, but they want to expand to a larger location, maybe closer to major roads where there's a better traffic count. They buy the land first, begin constructing the new facility or building, and then take 180 days to sell the existing one, all while they continue to operate their business. So all 3 of these really provide a lot of opportunities and options to taxpayers. I will tell you they're much more complex. There are a lot more moving parts. There's a lot more due diligence from the end of a qualified intermediary, and the fees are considerably higher than in a normal delayed exchange. On the next screen, we're going to get into a little bit of the interplay between 2 different tax code sections. So Section 1031 that we've been talking about provides for tax deferral on any property held for investment or used in a trade or business. So the basis carries over. IRC Section 121 is what's known as the primary residence tax code. This provides tax exclusion up to certain threshold amounts, so up to $250,000 for single filers and $500,000 for married couples filing jointly. So Section 121 is a better tax code section that you actually exclude. Section 1031, you just roll over or defer the taxes. So we're going to look through some different scenarios, and the 3rd, 4th, and 5th bullet points of what we're going to look in more detail. One is what's called a split treatment transaction, where there's part 1031 exchange tax deferral and part Section 121 tax exclusion. The next scenario is converting a rental property, so something that was exchanged into later converting it into a residence, and then finally converting a residence, a house that somebody lives in, into a rental property that it then goes through a 1031 exchange as relinquished property. So I want to touch upon some of these scenarios. And again, I'll give you the caveat. It's very important that you review your specific situation with your tax advisor. So IRC Section 121 is tax exclusion. It's available when somebody lives in a house for 2 out of the past 5 years, and it's available every 2 years. So the maximum amount excluded is $250,000 for single filers and a maximum of $500,000 for married couples filing jointly. Well, let's look at a split treatment. And there are different ways this could be done, let's say in a fourplex. Another example of a split treatment might be a large ranch or farm where somebody lives in a relatively modest farmhouse, but they've got significant acreage that is appreciated. That's another split treatment transaction. It's very important that the taxpayer get together with their tax advisor to allocate what portion of the property is considered 121, where they live in, versus the investment portion. So that's going to be done with somebody's accountant, tax advisor, CPA. The proceeds from the primary residence can be received directly by the taxpayer because they lived in it. So let's look at an example, a fairly straightforward one on the next slide. You see an example of a fourplex. The taxpayer lives in one unit, they rent out the other 3, and they find one buyer for the fourplex. The one residence, the 121 property, they receive those proceeds directly. They then work with a qualified intermediary and do a 1031 exchange on the remaining 3 units. A scenario we get asked about a lot is converting a rental property that was acquired in an exchange into a residence later on. And we touched upon this earlier, but I want to reemphasize it. It must be the intent in any exchange. The intent must be to hold both the relinquished property and the replacement property for investment purposes or used in a business. So the intent must be to do that initially. There's a minimum 5-year holding period in this transaction. Then you've got to look at the Section 121 exclusion is reduced by a ratio of the amount of time the property was used as a residence compared to the time that it was rented out. And depreciation recapture is not eligible for the Section 121 tax exclusion. So let's look at a real-life example. Taxpayer performs an exchange into a single-family rental, and they rent it for 3 years. Then the taxpayer's intent changes down the road. So 3 years from now, they move into the property, and they live in it for 5 more years. So total ownership period's 8 years, 3 years as a rental, 5 years as a residence. So they meet the 2 out of 5 years for the residence rules. They're then eligible for 5/8 of the Section 121 tax exclusion. Because they lived in the property only 5 out of the 8 years, that's the ratio. The longer a taxpayer lives in the property, the higher that ratio is. So keep that in mind. Now, another twist on this is now converting a residence into a rental. So we got guidance from this a number of years back. Revenue Procedure 2005-14 looks at how do you apply 2 tax code sections to a property being sold. So if somebody lived in the property for 2 out of 5 years, they qualify for the Section 121 tax exclusion. Then they move out and they rent it. Well, now it's a rental property. So at the time they sell, they're able to exclude the gain up to those thresholds, $250,000 if they're a single filer, or $500,000 married filing jointly, and the remaining amount they can use a 1031 exchange to go ahead and acquire another replacement property. So it's a really interesting planning strategy to take advantage of both of those tax code sections. One of the most important things of any exchange is doing due diligence on that qualified intermediary, who's holding the funds. Very, very important to do that. There are a handful of states, and you see on the screen, at the present time, California, Colorado, Connecticut, Idaho, Nevada, Oregon, Virginia, and Washington. There are some state-level consumer protection laws regarding 1031 exchanges and qualified intermediaries. However, at the federal level, there are no federal-level regulations for the qualified intermediary industry. So it's really important you look at the security of the funds. How are those funds secured? What sort of security mechanisms are in place? At Asset Preservation, we strive to offer the highest levels of security. The funds are invested and put into a separate account on behalf of each taxpayer. Our parent company, Stewart Title, which has been in business for over 125 years and publicly traded on the New York Stock Exchange under the symbol STC, they, upon request, will provide a letter of assurance assuring our performance of not only the exchange, but also backing the funds. So that's one of the safe harbors provided in the Treasury regulation. So we believe we offer, some wonderful and the highest levels of proceeds security. Some things that you want to look at with an exchange company. Does that qualified intermediary offer segregated accounts? You don't want exchange funds commingled with other accounts. The QI can offer a qualified escrow or trust account. Sometimes, in fact, most of the time, there are charges for those. You certainly can look at the fidelity bond coverage, but I'll point out that, even though it might be a big number, sound like a big number for coverage, relative to the funds being held by the qualified intermediary, it might be fairly small. And another resource certainly is the Industry Trade Organization, the Federation of Exchange Accommodators, and their website is 1031.org. So many reputable qualified intermediaries are a member of the trade organization. So that's another resource. Finally, in wrapping up, we tried in this intermediate level presentation to give you a little bit more detail and go through some little bit more nuanced subjects, things like partnerships and issues of that nature. Nothing is a substitute for reviewing your specific transaction with your tax or legal advisor and calling asset preservation, because we can give you some input and guidance on the process and the rules. Our number at our headquarters in California, Roseville, California, is 800-282-1031. Our Eastern Regional Office in New York is 866-394-1031. Our website has a lot of information at apiexchange.com. And then finally, if you feel more comfortable, if it's after business hours, our email to communicate is info@apiexchange.com. You can send an email there. That's monitored by senior management, and we will respond promptly and give you some input based upon your email. So we certainly want to be a resource. At Asset Preservation, our goal is to provide top-notch customer service, to be very knowledgeable. We've got very, very strong systems and controls regarding the security of the proceeds. We've got excellent documentation. We want to be a resource to you if you're a real estate investor or business owner. If you're a real estate agent or broker or an attorney or a CPA or a closer, we want to be a resource to you on your 1031 exchange transactions, and we appreciate your referrals. So please call Asset Preservation. We're going to conclude this intermediate level PowerPoint presentation now. Thank you very much for your time.